Today's session is designed to provide you a brief history of the corporate credit union system and how it ties into the overall credit union system and your credit union specifically. We will cover how and why it was started, its growth over the years, the impact that the financial crisis had on the system, and the current status and outlook for corporates. The origins of the corporate network go back to the 1970s, when most credit unions were operating close to 100% loan-to-share ratio. Credit unions were constantly having cash flow issues between payroll cycles, and the only source of liquidity and correspondent services were local banks. Credit unions did not yet have access to the Federal Reserve System, and the fees and rates credit unions were paying for bank services were exorbitant. These factors prompted credit union leaders to begin discussions about forming their own self-sustaining correspondent banking system. If credit unions were such a good deal for consumers, wouldn't a credit union-owned banker's bank model be a good idea for credit unions? Also of note, back in the 1970s, credit union volunteers were restricted from borrowing at the credit union on which they were serving. This was the credit union system's way of avoiding even the slightest potential for conflicts of interest. Therefore, just about every state had what were called central credit unions, which were credit unions established specifically to serve credit union volunteers throughout the state. By the late 1970s, credit union regulations had changed to allow volunteers to obtain lending services from their own credit unions, thus reducing the need for central credit unions. Many such entities changed charters and became corporate credit unions to start serving credit unions. U.S. Central, the country's only wholesale corporate credit union, was chartered in 1974, followed closely by the chartering of retail corporates from 1975 to 1981. So by the early 1980s, the credit union system had created both a tiered legislative and tiered financial system, with natural person credit unions, known as NPCUs, owning both systems. On the legislative side, you had state leagues and CUNA as the national organization that tied the system together. And on the financial side, you had state and retail corporates and U.S. Central that tied the financial system together. The primary purpose for the formation of the corporate credit union system was to help credit unions manage liquidity. By aggregating deposits at one central entity, a corporate credit union, it became much easier and quicker to move money from credit unions with excess cash to those short on cash. With the connection to U.S. Central, the corporates provided a national distribution system for moving liquidity throughout the credit union system. Initially, corporates just managed overnight investments for credit unions. As credit unions and corporates grew in size, corporates became increasingly involved with creating and selling investments to credit unions. In addition, corporates developed and offered all of the correspondent banking services that credit unions had previously obtained from their banking competitors. The governance of a corporate credit union is basically the same as a natural person credit union. Volunteer directors are elected from the membership, one vote per member. NCUA regulations do require that representatives from the member credit unions serving on the corporate boards be either the CEO, manager, CFO, or COO. The volunteer supervisory committee members are appointed by the board. The original plan for the corporate network was to mimic the Federal Reserve's 12 districts, since the corporate system would be the credit union system's conduit to the Federal Reserve System. However, by the 1980s, there were 43 corporate credit unions, almost one per state. By 2007, prior to the financial crisis, the system had already consolidated down to 27 corporates from the original total of 43. To say the financial crisis and housing market collapse had a dramatic negative impact on the corporate credit union system would be an understatement. As we entered the crisis, U.S. Central and the three largest corporates all found themselves way over-concentrated in private-issued mortgage-backed securities, meaning the mortgage securities had no implied or guaranteed government backing. Due to the high default related to mortgage loans held within these mortgage securities, market values plummeted on these securities and losses started to mount. In the end, a total of 5 corporates were conserved, including US Central. The NCUA set up the Corporate Stabilization Fund to manage down these conserved mortgage assets, and the credit unions and the remaining corporates were levied several years of assessments by the Shared Insurance Fund to cover projected losses. Since that time, we've learned that the credit union system was overassessed anywhere from $700 million to $2.5 billion, as the mortgage assets performed much better than originally projected. The full amount assessed to the credit union system was $4.8 billion. To date, NCUA has refunded more than $2.7 billion throughout multiple recapitalization distributions since 2017. Corporate credit unions also saw a significant recovery of capital written off at US Central. The corporates operating today have collectively reestablished their capital strength over the past several years. Much of this capital strength comes in the form of the member capital that was raised in the aftermath of the financial crisis, known as Perpetual Contributed Capital, or PCC. This makes corporates and their member owners true partners in serving the needs of credit union members. Today's corporate credit union system is very different from the network that was started some 40 years ago. Although some corporates were lost during the financial crisis, much of the consolidation of the corporate system is a direct result of the shrinking number of natural person credit unions. When the original corporate network was formed, there were about 24,000 credit unions. Today, there are less than 5,000 natural person credit unions and 11 corporate credit unions in the US. Since the pandemic, corporate credit unions have been subject to the same financial turmoil as credit unions. Inflated balance sheets, less than stable capital ratios, losses on investments due to rapidly rising rates, and tightening liquidity, just to name a few. But despite those challenges, corporate credit unions continue to pass through a majority of revenues back to member credit unions in the form of dividends and lower pricing on correspondent services. For example, Viso Financial provided a full reimbursement over a series of multi-million-dollar distributions to our capital members for the losses associated with the write-downs from the financial crisis. It was a demonstration of the dedication corporate credit unions have for their member institutions. In addition, corporate credit unions continue to serve their original intended role of being an aggregator of payment, liquidity, and investment services for the benefit of credit unions, with the addition of education, technology, payments, culture, and risk management. In general, after going through both the financial crisis and a worldwide pandemic, corporate credit unions find themselves in the best financial condition in their histories and are well positioned to continue playing their critical support role within the credit union system. As it was at the beginning, it is important to understand that corporate credit union's sole purpose for existing is to add value to the credit union system by supporting the financial and payment needs of its member credit unions. If your credit union capitalized a corporate such as Viso Financial, then your credit union is an owner and should use every single service possible. The ultimate success of a corporate is to maximize its returns to member credit unions. As a cooperative, the more credit unions that utilize corporate services, the better long-term value the corporate can provide its members. This concludes today's presentation on the history of corporate credit unions and the role we play within the credit union system. Thank you for your time today.